Stephanie Kelton. Professor Stephanie Kelton is back with us. She is the chair of the Department of Economics at the University of Missouri at Kansas City, the creator and editor of the blog New Economic Perspectives. NewEconomicPerspectives.org is the website. Her Twitter is at Stephanie Kelton, Kelton, and at Kansas City. Stephanie, Professor, welcome back to the program.
Thanks, Tom. Thanks for having me.
Thanks so much for joining us. It's always great to get your insight and perspective on things. The stock market continues to explode. It took a little bit of a dip today, I think, in response to what happened in Ukraine, but to this airliner. But the general trend seems to be upward. Everybody says, "Hey, everything is just coming up peaches, and it's wonderful. The economy is back on its feet." What's really going on?
Yeah, it's interesting, right? There is that tendency to conflate what's happening in the stock market with what's happening in the real economy. And so a lot of folks do look at the stock market as a barometer for the overall health of the economy. And of course, it's not a very good one if that's what you're doing. You're absolutely right. Stocks look very good. In some people's eyes, they look maybe a little bit too good. But for most Americans who, of course, don't own any stock and don't feel better necessarily when the stock market goes up, life's still pretty tough for them.
Yeah. So are we in an asset bubble?
Well, I guess it depends which market you're looking at. There are definitely markets that I think are looking pretty bubbly, and I think increasingly the finance community is starting to talk like maybe they are beginning to worry a little bit themselves. And they tend to be more bullish than the average person on these sorts of things. So, if you look at student debt, if you're looking at equities, if you're looking at housing, if you're looking at leveraged corporate bonds, junk bonds, there are actually a lot of different asset markets that I think right now are beginning to look pretty bubbly.
What are the conditions that cause bubbles?
Well, people begin to buy on the anticipation that prices can only go up and go up at an accelerating rate.
But that assumes that people have money to buy with. Most middle-class Americans are now in debt or struggling to get by.
Yeah, so these asset prices are not being pushed up by average Americans. That's absolutely true. Prices are increasing because there is a lot of cash sloshing around, and folks who've got cash have been pushed by the Fed into riskier asset classes, and this has driven up prices in equities and housing and other sorts of asset markets. So you've heard people, of course, talk about the pushing people to reach for yield. Well, that's, I think, what we're seeing.
Right. So when you say pushed by the Fed, you're talking about pushed by the Fed keeping interest rates low?
Yeah, a combination of keeping interest rates low and committing to keep rates low for a sustained period of time. At one point, Bernanke said through 2015. I think most investors now think rates will probably go up sometime in the middle of 2015. But early on, the forward guidance, so to speak, was that rates would be low through the end of 2015. And so investors said, well, look, if rates are going to be kept low for that length of a period of time, and at the same time the Fed is doing, QE, the combination of the two things just left an awful lot of players with some pretty sizable cash holdings and not much else to do with them. So
they throw it into the stock market.
Off we go, sure.
Yeah.
And of course, investors buying up real estate and then turning it into rental property. So you've got that happening as well.
Yeah, and postage stamps and baseball card collections and fine art and
great wine, old wine, whatever.
Yeah,
sure.
I mean, it's amazing, and isn't this really a symptom of economic inequality? Too much money sloshing around in too few hands, and they don't have anything to do with it, and so therefore they're looking for returns.
I definitely agree with that. I mean, look, we've seen since the start of the so-called recovery, and of course it doesn't feel like a recovery for most Americans, but since the start of the technical recovery, 80% of all the income gains have gone to the top 20%. I mean, it's just, the gap already, as wide as it was between those at the top and everybody else, has just significantly widened in the economic recovery. So Yeah, we have a very uneven, imbalanced recovery. Those at the very top are doing extremely well, but when they're doing extremely well, they don't go out and buy another refrigerator. They don't go out and, get another TV just because they have a little bit of extra disposable income. They plow it into investments, and so stocks and, that sort of thing. So, yeah, I completely agree with you.
Yeah, billionaire Nick Hanauer said on this program, I can't own 10,000 pairs of jeans. I only buy 3 or 4 a year. And even though I've got $1 billion. And so is a solution to roll back the Reagan tax cuts?
Well, I mean, increasing taxes on those at the very top would, in fact, help both reduce inequality and also, I think, reduce financial instability for the very reasons that we just talked about. So, I think it addresses two problems. What it doesn't do is raise the incomes of everybody else. Okay, so you can reduce income inequality by raising taxes on those at the top, but then you've got to do something else, either significantly cut taxes for people who are, working for a living, ordinary Americans, or you've got to increase spending in the type of way that would increase growth and incomes for the vast majority of Americans. Yeah. So it's not enough just to raise taxes on the rich.
Well, I remember back in the 70s, I had a business that was going great guns. It was an herbal tea company, and we were making a lot of money. And this was before the Reagan tax cuts. The top tax rate, in fact, I think it was after the LBJ tax cuts. So the top tax rate was 73%. And our CPA came to Terry and I, my business partner and I, and said, you guys are taking money out of this company at such a rate. If you continue this through the end of the year, you're going to be paying more than 50% income tax. That's crazy. You need to put the money back into the business. And so we did. We developed a whole new line of products, ended up hiring 6 or 8 more people, dropped a bunch of money on advertising, and significantly grew the business rather than taking a larger paycheck. Back then, CEOs were only taking 30 times what the workers did. And I think a lot of people were following that logic that we were following. Doesn't that indicate that high tax rates on the very top end actually do drive money down into the average working people?
I'm sorry, doesn't it indicate that, because you say that again, I lost you right at the end.
Okay. I mean, we added our hiring, and we also expanded benefits to our employees because it was pretty important to keep them. Isn't that a consequence of higher tax rates, or was my experience anomalous?
Yeah, I don't know, Tom. I mean, I think you're cut from a different cloth. I don't know how generalized that behavior was during that era. I think it's an interesting question. It'd be nice if that were the case, if employers understood that their own well-being, economic well-being, is bound up in the well-being of their customers.
Yeah. Well, the average employer or CEO is only taking 30 times what their workers were, so you can make an argument for it. But it may be an anecdote. It's purely anecdotal. But Professor Stephanie Kelton, it's always great talking with you. Thanks so much for being with us today.
Thanks, Tom. Great to talk with you.
Thank you. Neweconomicperspectives.org is Professor Kelton's blog. Check it out. We'll be back.